From New York City, for our viewers worldwide, I'm Matt Miller, in for my good friend Jonathan Ferro. We're looking at markets right now that are doing a heck of a lot of nothing in terms of the equity indexes, right? S&P futures right now down just 0.1%, a little bit less. Russell 2000 futures gaining about 0.2%, but oil continues to ride. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
Coming up, Treasury yields testing multi-year highs as well, with global central banks in focus all week. Auto workers remaining on strike after the UAW calls the latest offer a no-go. And the UN General Assembly kicks off amid simmering U.S. tensions with China. Don't try and drive in Midtown Manhattan. We begin with a big issue, looking ahead to a Fed rate decision.
There's obviously a pretty critical Fed meeting.
The Fed will do what we all expect it to do.
They'll pause.
Pause.
It's going to be probably a hawkish pause.
A hawkish pause.
A pause, but an indication that they're prepared to do more.
Leave the option open that there'll be another hike.
They'll keep wide open the possibility of another hike.
I don't think they can say they are done.
They're going to remain vigilant.
November is really what the market is going to look towards.
We may very well be at the end of rate hikes.
We see inflation coming down.
They're going to raise rates in November.
The economy is still growing above potential.
It's a really tricky needle to thread in terms of doing just enough, but not too much.
Whether they hike again in November is yet to be seen.
Joining us now to discuss is BlackRock's Marilyn Watson, as well as Nuveen's Anders Persson. A lot going on in terms of the Treasury market, a lot going on in terms of oil, not a lot in terms of stocks right now. Marilyn, what do you think about 434, 435 on the 10-year?
Yeah, I mean, I think, as you say, this is a very, very busy week for central banks. I think the market has just been trying to really absorb the price of oil, try to absorb the recent data that we've had in the US, which continues to be, pretty positive overall. And I think, this week our view is that the Fed will, continue to pause, be on hold this week, and then, but they'll make it very, very clear that they are still data dependent and that, November, we'll see what happens. But I think the market's just trying to really position itself and gauge what's going to happen this week, because we also have, the Bank of Japan, which is potentially more of an unknown. We have the Bank of England, we have a range of central banks. And I think given the focus on those, I think the market's just sort of, moving around with that.
Anders, what do you think? I mean, right now, back up to 435 on the 10-year. It's been a choppy morning for the yield trade, but you don't sell these bonds going into the pause, do you? Expecting a Fed hike coming later?
Yeah, at this point, we're certainly not expecting a hike this week. I think it's going to be this kind of hawkish pause that a lot of people have been talking about. I think they're going to reiterate this message from Jackson Hole to proceed carefully, kind of staying data dependent. And the big question mark is, are they going to do something in November? And markets are pricing in roughly a 40% probability of some kind of move maybe later in the year. But right now, I think they're going to try to buy some time. I think really the markets will probably look at the dot plots a fair bit, kind of see if there's some changes there, particularly for the 2024 kind of type dot plot, because from that perspective, we had 100 basis points cuts kind of lined out from the Fed. We think that could maybe change to 75 basis points. So a little bit of new messaging from that perspective. But all in all, not expecting much fireworks this week from the Fed.
Marilyn, what do you expect from the dot plot and from November? I mean, this market has been overly optimistic throughout this Fed rate hike cycle.
Yeah, so in terms of the dot plot, as you know, at the moment it's essentially showing sort of 5.6% year end this year, down 4.6% end of next year. I think we'll be focusing on, we expect them to remain pretty much the same for this year, given that while we think they'll be on hold, they are still very, very data dependent. The question is, I think, more whether we could see an adjustment to that, but more I think it's, again, next year, what could we see, whether we expect to see, and whether the voting members expect to see rates higher for longer. And as you know, you do expect at the moment they're showing a cut of 1% in total next year, but from where they currently think they'll end this year. But we could see next year and also further out into 2025 as well. If they expect rates to be higher for longer, then I think that will have an impact.
What has to happen for a 1% cut, Marilyn? What has to happen for 4 cuts next year?
So at the moment, the economic data, I think, has consistently surprised to the upside, both for for the FOMC as well as for many market observers as well. And I think what we would need to see for them to change, or what they're expecting next year, is to see if they were to maybe reduce their forecast further for next year in terms of interest rates. We would probably have to see more deterioration in terms of economic activity, the US economic outlook. Also in terms of inflation, it has been moderating, it is coming down, but it's still above the target. And so, but I think really what we would need to see is a deterioration really in economic activity, in GDP, in the unemployment rate, in the labor market. And at the moment, we're just not really seeing that in the terms of the data.
All right, Anders, Marilyn, sit tight. I want to get over to Mike McKee because, early this morning, I thought crude had to be the asset class to watch today. But you look at these intraday graphs, and yields are just taking off right now. The Fed obviously headlining this busy week of central bank decisions, with the Bank of England and the Bank of Japan among the others meeting, and maybe the latter being more interesting. But Bloomberg's Michael McKee joins us now for more as we watch. We just saw almost 508 on the 2-year. We're looking at 435 on the 10-year. They're taking off.
They're taking off, and it's because who needs the UN General Assembly, Matt? We've got the Global General Assembly of Central Banks. Not only did that chart show you a few of the people who are meeting beyond the big three, but we have meetings this week for central banks all over the world: Indonesia, Philippines, South Africa, Sweden, Switzerland, Taiwan, Turkey, Egypt, Brazil, Norway. Just the list goes on and on and on. And in general, most of them are going to be looking at raising rates, or at least sounding hawkish as inflation continues. And now we see those oil prices going up. The big three will get the big attention, however, and rate hike odds, as you mentioned, Matt, are getting a little interesting. The Fed, nobody cares. They don't think the Fed's going to raise rates this meeting. It'll all depend on what Jay Powell says. But the Bank of England is pretty much priced in for another move. And then you take a look at the Bank of Japan. It's been a long time since people really traded on the idea that the Bank of Japan might do something. They don't think they will actually raise rates this month, but they do think that what we're going to see at some point here is them getting a hawkish tilt towards their policy because inflation has risen high enough. And you can see there that they are going to be the most interesting of them all because the Bank of England and the Fed have already raised rates so much. Look how far back you have to go to see a movement in the Bank of Japan's base rate. The number to watch, though, this fall or this Friday is the dollar. Once we get through this week of all these central banks moving, where does the dollar end up? We've seen the dollar index continue to rise as the Fed has raised rates, and that'll be a signal to the rest of the world about where we are going now. If the world thinks that maybe the Fed has slowed down, then we will maybe see a little bit less pressure on the other central banks. So right now, keep an eye on oil prices going into the week. At the end of the week, let's see where the dollar is.
Yeah, we're looking at $92 now for WTI, West Texas Intermediate on the NYMEX, $94.84, so near damn to $95 for Brent. What do we look for in the dot plot, in the SEP? I think we get that this time, in the face of rising oil prices.
Well, we're probably not going to see a whole lot of change, Matt, because we don't know how long those rising oil prices are going to, A, continue to rise, and B, how long demand is going to hold up for gasoline prices when they start going up. So the Fed can't really forecast that. But look for the dot plot to still retain the idea of one more move this year because they don't want markets to start pricing cuts. And then look for the summary of economic projections to suggest we may have a little bit stronger growth and a little bit less unemployment than the Fed had forecast going forward. We'll want to see what they say about inflation as well.
All right, absolutely. I hope we don't hear the word transitory, though, even in relation to oil. Mike McKee there with a look ahead at this busy central bank calendar. Sticking with central banks, Nouriel Roubini delivering a warning to the BOE and the ECB. Take a listen.
The problem is that the Bank of England right now is sending sort of dovish signal in a situation in which the policy rates are well above the Fed, but inflation is well above the United States. So what they should be doing is actually hiking rates all the way to at least 5.75. The signals are telling us right now is they're not sure whether they want even to hike more. If that happens, there could be a de-anchoring of inflation expectation. You could have a true stagflation. That's a dilemma for both the ECB and the Bank of England.
Marilyn Watson and Anders Persson back with us. Anders, let me ask you your take on the other central banks. I mean, how close are you paying attention to what happens at the Bank of England, what happens at the Bank of Japan, considering that the Fed has been driving policy globally until now?
Yeah, no, at this point, you definitely have to pay attention to all these kind of key central banks for sure. I think, certainly the Fed is still setting the tone more or less globally, certainly here for the US, but I think all these data points are important. I think Bank of England, I think, is probably in the most tricky spot right now. Most central banks, we do expect, as Michael mentioned, as the market is expecting one hike here coming to 5.5%, and maybe one more after that as well. I mean, it's just a very tricky environment going on in the UK at this point, more broadly. The Bank of Japan is probably going to be, a little bit less influential here for the near term. I think the market has already kind of accepted that the yield curve control is playing through a little bit here, and I think overall that's been fairly well messaged in the market at this point. So all in all, I think the focus will quickly go back to the Fed and potential next steps that the Fed's going to be doing in the November timeframe.
Marilyn, what's your take? I mean, everyone's excited about the Bank of Japan because it'll actually, potentially do something interesting and different. But does it matter as much?
So it does matter. And I think in particular, it does matter increasingly going forward as we do see the Fed get to the end of this rate hiking cycle. And then we look at the divergence in terms of the economies, the economic activity of the different regions. I mean, we're seeing increasing divergence between the US economy, the UK certainly, the Eurozone, and then Japan, again, is in a very different situation. So I think it does matter, and it will matter increasingly as we do start to see, this divergence in terms of when central banks get to the end of the hiking policy, but also in terms of economic activity, prices, valuations, and then where investors can find opportunities globally, in the different regions and in the different, financial asset markets as well. So I think as we do see, the Fed potentially pause and get to the end of the cycle, I think it does matter, and I think it matters for investors to be able to really be nimble and really get at the different opportunities that we'll see as we do see, a dislocation potentially between market pricing and the opportunities for investors.
All right, looks like we bounced off 148 yen to the dollar with greenback strength continuing, but maybe that's a level to watch. Marilyn Watson and Anders Persson are sticking with us, joining us now with a look at the stock market ahead of the opening bell. Here's Abigail Doolittle. Abigail?
Well, Matt, we do have U.S. futures lighter by just a little bit. Let's take a look at what's weighing, starting out with the shares of PayPal, down about 1.7%. This as MoffettNathanson has downgraded the stock to a market perform from an outperform as the growth outlook slows. Lisa Ellis is saying that profit growth will remain anemic and EPS growth is slow as PayPal is facing fierce challenges. Tesla had been higher earlier in a Wall Street Journal report that Tesla and Saudi Arabia are in early talks for an EV factory, but with yields higher pressing big tech down. Ford down 0.8% along with Stellantis. This as the UAW strike is in its fourth day. So a little bit of soft stock action this morning, Matt.
Yeah, very interesting developments on that front. A 21% pay rise offer pushed aside at Stellantis by the UAW. Thanks very much, Abigail. We're going to talk more about the union coming up unmoved by this sweetened offer.
So 21% is a no-go for you?
It's definitely a no-go, and we've made that very clear to the companies.
U.S. auto workers extending their strike to a fourth day. That conversation up next. This is Bloomberg.
So 21% is a no-go for you?
It's definitely a no-go, and we've made that very clear to the companies. We're prepared to do whatever we have to do, so the membership is ready. The membership is fed up. We're fed up with falling behind. It's been decades of falling behind.
UAW President Shawn Fain rejecting the latest pay raise from Stellantis, the automaker calling the offer a compelling solution for protecting jobs at an idled Jeep plant in Illinois. The disagreement signaling, though, that the union and Detroit's Big Three are still pretty far from a deal 4 days into the strike. Bloomberg's David Welsh joins us from Detroit. He's our bureau chief there and has been covering this very closely with his team. David, you know, we focus so much on the pay part of their demands, but the union has asked for a lot more than just a 36% pay increase at this point. They also want to bring back defined benefit pension plans, and I believe they're still sticking to a 4-day work week. What's the status of the demands from the UAW?
Look, they still want those things. The companies, if you look at their offers, that stuff's never in there, particularly the retiree stuff. They've even asked for retiree health care. Those are the two big ticket items that just weighed down the balance sheets of all three companies, played a role in driving GM and the former Chrysler into bankruptcy. Ford had to borrow $24 billion to stay out of bankruptcy. They're not going to do that. The companies will take a very long company-wide strike before they would agree to those, fixed retiree benefits. They are willing to move on pay, obviously. They're already up over 20%, and I think they'll continue to bump that, not interminably, but they will. That's something they can play with. But those other retiree benefits and the 32-hour work week, I don't think they'll budge on either one of those.
In terms of the damage this could do to companies, when you think about handing out a 21% pay increase to so many tens of thousands of workers, you might worry that it bankrupts GM, Ford, and Stellantis. But they've done well, and it's not actually a huge part of the cost of a car, is it, labor?
No, I've seen estimates. It's somewhere between 5 and 10% is the cost of labor. There's a lot of other labor in there from the suppliers, but they wouldn't all be getting 20% raises. So, yeah, it will bring their costs up. It will bring their labor costs would definitely be uncompetitive with Toyota, Honda, Tesla, Hyundai, and Kia. They'll be in a worse position. But there are two things. One, it's not the kind of money that bankrupts the companies. It eats into what are now very good profits. And two, these other companies, and we've seen Toyota do it over the years, they've had to raise compensation and improve benefits to keep the UAW out of their plants. You can't be at a $5, $8 labor disadvantage versus a UAW contract and expect your workers to not maybe listen when a union organizer comes around. So union contracts do, and they have, raise all boats. Now, they've always stayed, something under what the UAW can get to maintain the advantage, these other companies. But they will end up having to pay more as well if they want to keep the UAW out of their factories.
Yeah, it's a very interesting point in terms of the competition, and it'll be interesting to see if a win here for the UAW can actually get them into some of those competing plants. David Welch has been covering this. We'll continue to. Obviously, the big story, I would argue, not just in Detroit, but nationally right now. Marilyn Watson and Andres Persson are back with us, and let's talk about how this strike could translate into the fixed income world that you guys are so focused on. Marilyn, clearly it's going to drive up compensation, so there's the concern about a wage spiral, driving inflation further. Is that the only connection that you can see?
So I think it certainly, highlights the strength of the labor market at the moment. And I think in terms of the fixed income market in the long term and what that means also when you look further down the line at monetary policy as well. I think that, one of the factors to really bear in mind is that the US has an aging population in terms of demographics. You're seeing, many people becoming of pensionable age. You have a workforce that, you don't have the same supply in terms of younger workforce. And I think we'll continue to see these pressures for some time in terms of we've already seen the last couple of years, particularly since COVID, just how strong the labor market has been, how there's still a deficit in many areas in terms of getting the number of employees in different sectors back to pre-COVID levels. We've seen pay rises, across the board in most different industries. And so I think, in the long term, it just really highlights the fact that it is an aging population, that the economy is still very strong at the moment. And we've already seen this in other sectors where we have seen wage rises.
Anders, obviously, wage price spiral is the phrase that was eluding me there. It doesn't seem that monetary policy is really holding that back. What connections do you see with the fixed income world that you run at Nuveen?
Yeah, no, I would echo those comments, basically. I think the broader dynamic here is more key here, that the labor market remains very tight and wage pressures really haven't eased sufficiently. I think the Fed's going to keep a very close eye on that. And more broadly, these kind of type actions and discussions is going to put pressure on wage prices and inflation moving forward overall. That being said, I think it's important to keep in mind that from a credit perspective, we're not expecting these discussions to really put a whole lot of pressure on these issuers. You're seeing bonds and stocks and CDS, for instance, holding up just fine for GM and Ford and what have you. So it's been pretty well flagged, and we're not seeing much deterioration from that perspective. So I think investors, they basically appreciate that this is an uncertainty, but this industry and this sector has come a long way and is pretty well positioned. And so I think there's a balance there that we're trying to make sure that we're basically taking into account at this point.
All right, Anders, thanks so much for joining us. Anders Persson there from Nuveen, Marilyn Watson joining us from BlackRock. Pleasure having you on the panel today. Coming up, the morning calls, and then later Morgan Stanley's Andrew Sliman joins us, making the case for an equity rally in the next quarter after this September lull. That conversation still ahead. This is Bloomberg. Time now for our morning calls. A look at some of the analyst recommendations on Wall Street that could affect the market this morning. First up, MoffettNathanson downgrading PayPal to a market perform, expecting softer EPS growth due to mounting competitive pressures there. Next up, Guggenheim upgrading Ralph Lauren, or is it Lauren, to a buy, seeing an attractive entry point with shares 14% down off of this year's peak. And then finally, Deutsche Bank upgrading Micron, the chip maker, to a buy, saying recent checks point to improving chip prices and strengthening demand for that sector as well. Coming up, Morgan Stanley's Andrew Sliman on why he expects stock to rally heading into the year end. That conversation up next. This is Bloomberg. This is the countdown to the open. I'm Matt Miller for John Ferro. We've got equity indexes moving down for the big caps, not so for the Russell 2000. You've got an all-star lineup of bell ringers at the NYSE and the NASDAQ moments away from the start of trading. Here are the opening bells. One stock to watch at the open, we're going to get to in just a moment. Here you see the euro dollar at 106.69, the 10-year yield. That's really the stock to watch, is the 10-year yield, I think, or the price of oil. Both of them soaring to highs that we haven't seen in months, if not years. 435 almost on the 10-year. NYMEX crude at 91.86. So there you go. Former Vice President Al Gore ringing the bell at the NASDAQ. One stock to watch at the open, I was going to say Apple. Shares edging higher as pre-orders for the new iPhone 15 surpass expectations. Bloomberg's Abigail Doolittle is here with more on Apple. Abigail?
Well, Matt, it's interesting because there's a little bit of a mixed picture in terms of these pre-orders. Let's save the bullish picture for the end on a bright spot. But there are a couple of analysts out there saying that these pre-orders for the iPhone 15 might be a little bit flat. In particular, Barclays is saying that the early pre-order data point that China continues to point to a difficult iPhone 15 cycle with a negative mix shift, meaning trending toward the lower end phones. Bernstein saying historically Apple, the stock, has treaded water a bit after these iPhone launches. That is true right now. We have Apple breaking down to some degree, down more than 9% or around 9% in this quarter. Although today we do have Apple up 1.1%. So let's get to the positive. Morgan Stanley saying that the early iPhone 15 pre-order data is good. And Wedbush going even further, saying that the trend is toward the higher end phones and that it could be 10 to 12% above the iPhone 14 orders. Most important, Matt, I think to some degree are the numbers. This company has been showing over the last few quarters negative growth for both top and bottom line. The first quarter of their fiscal 2024, which is the December quarter, is expected to show a return to growth. If they can have that growth for the December quarter, well, Apple might come out of its recent doldrums.
All right. Abigail Doolittle there on Apple. Let's turn to the media space right now. Disney holding preliminary talks with potential buyers for its India streaming and television business. Bloomberg reporting Disney is weighing strategic options for the business, including an outright sale or setting up a joint venture. Plus, heck, we've had so much news on big asset moves over at Disney. Let's bring in Bloomberg's Ed Ludlow from the West Coast here in New York.
Yeah, good morning. Good morning to you, Matt. Disney modestly lower, 0.3%. What Bloomberg sources are saying is they could take the Disney Star property in India and sell it outright, or they could do more of a piecemeal approach where they take the sporting rights that are India-based and the Disney Hotstar regionalized streaming platform, put them in combination. As you said, Bloomberg had also reported first in July that forming a joint venture in the region is an option. It's interesting because one of the parties in talks, according to Bloomberg sources, is Mukesh Ambani's Reliance Industries. That goes back to Disney losing the rights to the Indian Premier League cricket in that nation. Where did those rights go? They went to a JV between Mukesh Ambani's Reliance and also Paramount. So now Disney looking at his options, an outright sale potentially, a joint venture, or a more piecemeal deal where specific rights and properties sold off. By the way, the stock's off to 0.2%. It was initiated at Raymond James this morning with an outperform. And their argument's basically like it's been a horrible time for media companies. But beyond that, cash flow looks good, valuations look good compared to the rest of the sector.
All right, Ed, thanks very much. Ed Ludlow there taking a look at Disney for us. Now, a cybersecurity incident that affected Clorox last month has been contained after addressing the unauthorized activity. The company saying the attack damaged portions of the IT infrastructure, which caused wide-scale disruption of Clorox's operations. The company now believes the impact will be material on Q1 financial results. Simone Foxman here with more. You'd rather hear marginal there than material, wouldn't you?
I think you would, and it's unclear, the company says, if this will actually weigh on its full year guidance as well. And that's why we're seeing shares fall in today's trading, now down about 1.5%, weakest since early February. But more details of this cyber attack is really that it's continuing to have all these impacts on operations. The company's saying it's operating at a lower rate of order processing and that customers are feeling some of the impact of product availability issues. It damaged the IT infrastructure that the company has. And I think this is really concerning as well. The company isn't going to be able to move back to its normal automated processing for orders until the week of September 25th. So we're not already back where the company should be. Now, this will have a material impact on the Q1 financial results. That is the quarter that ends in September 30th. But the company's saying, again, it's premature to look at the year and potentially see an impact there. Bloomberg Intelligence is saying that this is really a concern for the company as it tries to transition from this price hike-led sales growth to the volume-led sales growth has the potential to weigh on margins, and that's clearly being reflected in trading today. Matt.
All right, Simone, thanks very much. Clorox down 2% at the open. Let's turn to the IPO market, stories around which have been very hot lately. Online grocery startup Instacart has been flirting with an IPO for years now, and it's finally taking the plunge, making its trading debut tomorrow. Bloomberg's Shonali Basak has more. Shonali?
Matt, you're looking at Instacart, which will price tonight, start trading tomorrow, as you've been saying. And last week, after the successful ARM IPO, Instacart and its bankers went ahead and increased its price range. Now, at the high end of the price range, you would have a company worth more than $9 billion, almost $10 billion. And while that's below its most recent funding round, where it was valued at about $13 billion, the name of the game for the IPO market is no longer high flying. The new game in town is smooth sailing. So you do have these companies now looking to set expectations, make sure that they're making it into the market with a popular IPO pop. These pops, as we saw with ARM, could be muted at first, but you saw ARM continuing to hold steam into the next day of trading. Now, one thing Instacart has on its side so far is the cornerstone investors that it has lined up. Even though the market is watching the story on margins moving forward on Instacart, you do have PepsiCo coming in as an investor into the IPO, as well as cornerstone investors that could take up 60% of the shares. That includes a division of Norges Bank and Dan Sundime's D1 Capital. Now, do those names give the market enough heat to buy into the stock? One thing these firms have in their favor is timing. They're all coming ahead here of that big Fed decision on Wednesday. They are trying to get a calm market into their debut. Klaviyo, the following day, has also increased its pricing range. Will price tomorrow night, trade Wednesday.
All right, Shonali, thanks very much. Shonali Bassik there on IPO Watch. Let's get to Morgan Stanley's Andrew Sliman right now. He has been making the case for a rally in the fourth quarter, writing, quote, underweight to equities will likely become more painful into year end. According to consensus estimates, earnings are likely to inflect from negative or flat in 2023 to positive in 2024. Investors should greet the resumption of positive earnings growth warmly. I'm pleased to say Andrew Sliman joins us now. Andrew, great to get you on this. As we start to see all of the bears throw in the towel, has every last one capitulated? And wouldn't that make you nervous?
Sure. Well, it's one thing to say that you've turned from bearish to bullish. It's another thing if you put your money where your mouth is. And if you go and look at fund flows on a weekly basis, that follows from funds and ETFs, they remain negative on a weekly basis. And that is very symptomatic of the early stages of a recovering bull market off a bear market low, where investors are sellers. It happened in 2020 off the March low. It happened in 2009 off the great financial crisis low. Investors sell into the rally. That is consistent with the first stage of a bull market. Eventually they capitulate and they turn back and go in, but that hasn't happened yet. So it's one thing, sentiment is one thing. I watch what people do with their money. I think that's much more significant.
That's exactly, it's paraphrasing what Alan Greenspan, I believe, said, Andrew. In terms of valuations, what's the best measure to look at? Is it still, forward PE, and where do you put that?
Well, what Wall Street is classically overconfident in is their ability to predict earnings. I mean, it is yet again this year has turned out to be a better earnings year than what many on Wall Street predicted. So what I watch much more is revisions and what companies are saying versus what's expected. And you know what? That's turned out recently to be better than expected. So that number for next year, the consensus is somewhere just below $250. That's come up recently. And so I think that's more important. There's no question that interest rates weigh on multiples, but I think in a recovery earnings, we're going to get a rally first and then ask companies to deliver on what's expected next year. So I suspect this year will turn out to be an even better year for equities than next year.
In terms of the headwinds, are you concerned about, the consumer seems to be putting a lot more on plastic. Default rates on credit cards are rising. Same is true with auto loans. Student loan payments are going to resume. Oil prices, we're looking at $92 a barrel now for WTI, 95 for Brent. Households have run out of excess savings. I mean, the bearish list could go on and on and on, but I'm not sure how you feel about it.
Yeah, I mean, many of those statistics are what the bears throw out, but really has the household run out of excess savings? I mean, energy as a percentage of a consumer's expenditures continues to drop. Am I worried that the Fed is raising rates, interest rates moving higher tends to deter economic activity? Of course I'm concerned, but I think the story is that it's very hard to know when that will occur. And the simple reality is the consumer and corporations fixed a lot of debt during COVID so that they're less interest rate sensitive than they've been in the past. Doesn't mean it won't have the same effect. It just will take longer. And I think that's really what the story is. The inverted yield curve is telling you there's a slowdown out there. It's not very good at telling you when. And I take comfort from the fact that we keep pushing out the first Fed cut. I don't want a Fed cut because that's a sign of the economy weakening. The fact that we keep pushing that out, the fact that the 2-year yield remains high tells me the economy is stronger than what many people predicted.
What sectors do you like, Andrew? Because we've obviously seen most of this year's rally supported by only one, not even one sector, just a handful of companies. Do you see a broadening out? Do you like something besides tech here?
Sure. Well, but yeah, I mean, I like growth and I don't like value, or I don't like value, I like growth. I think you want a combination. What is clear, and again, consistent with the first leg coming off a bad bear market, is the worst performers are the defensives. And lo and behold, that's because, last year the market went down, defensive stock, consumer staples, utilities, etc., healthcare, they held up the best. And so what do investors do at the end of last year? They all piled into dividend-paying strategies. It was the #1 selling strategy last year, and yet that's lagged this year. So I think you want to have a combination of growth, technology, and value, financials, energy. And right in the last month or so, energy has really done very, very well relative to tech. So I suspect going into this fourth quarter, you'll get money coming back into many of these well-known cap names because they're liquid, they're easy to buy, and I suspect that their quarterly earnings won't disappoint.
Andrew, great to get some time with you. Thanks so much for joining us. Andrew Sliman, they are coming to us from Morgan Stanley. Coming up, GOP tensions looming over a potential government shutdown.
I want to make sure we don't shut down. I don't think that is a win for the American public, and I definitely believe it will make our hand weaker if we shut down.
Our team coverage up next. This is Bloomberg.
I want to make sure we don't shut down. I don't think that is a win for the American public, and I definitely believe it will make our hand weaker if we shut down. I gave them an opportunity this weekend to try to work through this, and we'll bring it to the floor, win or lose. I believe we'll get agreement this week.
That was House Speaker Kevin McCarthy speaking yesterday as tensions rise on a possible government shutdown. House Minority Leader Hakeem Jeffries saying, quote, "The House Republican civil war is hurting hardworking American taxpayers and limiting our ability to be able to solve problems on their behalf." Let's bring in Bloomberg's Kayleigh Lyons in Washington for more. So, Kayleigh, it looks like the Speaker making some pretty adult statements there. Is the class going to listen?
Well, this is the question, Matt. We are now just 13 days out from a potential government shutdown, and so it was a working weekend for House Republicans. We do have on the table now a deal between two very key factions, the far-right House Freedom Caucus, which includes many of the members that are giving Speaker McCarthy a headache on this issue, and the center-right Main Street Caucus. They have a deal that would temporarily fund the government for 31 days, so through October 31st. The issue is, even if it can pass the full House, which remains a massive question because Speaker McCarthy McCarthy is going to have great difficulty getting enough members in line with only a 4-vote margin of error. It wouldn't necessarily pass a Democratic-controlled Senate or be signed into law by the Democratic president, Joe Biden, who would have to sign it once it comes across his desk. The reason why is this measure that they have agreed to would include an 8% cut to domestic agencies funding everything basically except for veterans and the military. Also includes some measures on the border, like resuming construction of a border wall, making it more difficult for migrants to claim asylum in the U.S. It also doesn't include any funding for Ukraine or disaster aid that the Biden administration has asked for. So it's likely a non-starter if it can even get through the House of Representatives. That said, the Rules Committee is going to take it up today. They're planning a full floor vote in the House on Thursday. It's just not really clear that this measure is going to get us any closer to averting a government shutdown. And Matt, the clock is ticking louder and louder.
Absolutely. Kaylee, thanks very much. Kaylee Lyons there covering all things Congress for us out of Washington. Turning now to foreign affairs, National Security Advisor Jake Sullivan met with Chinese officials in Malta over the weekend, discussing a possible November meeting between Presidents Xi and Biden. The White House writing, quote, "This meeting was part of ongoing efforts to maintain open lines of communications and responsibly manage the relationship." This coming just ahead of the UN General Assembly here in New York City, which Xi plans to skip. Bloomberg's Anne-Marie Horton is in New York, and she joins us now. So, AMH, what do we know about, who's not coming to this meeting and how, we're doing communication with our with our foes and allies in other ways?
Well, that's right. I think what's interesting about this UN General Assembly, or as everyone likes to call it, UNGA, is the meetings that are happening not here. So Jake Sullivan over the weekend sitting down with Wang Yi in Malta is almost a breakthrough, I would say, in the meetings we have seen and the outreach we've seen from the U.S. administration to their Chinese counterparts, because this would really be the meeting that could set the tone and the agenda for a Biden-Xi bilateral meeting, which potentially could happen before the end of the year at the APEC summit in San Francisco in November. Then you have Wang Yi, on the heels of his meeting with Jake Sullivan, going to Moscow to sit down with Sergei Lavrov. So obviously there's going to be a swapping of notes, I imagine Wang Yi will take from Sullivan to Lavrov. So that's one of the interesting developments around this UN General Assembly. We also have President Volodymyr Zelensky to be attending UNGA in New York City. And while he will meet with individuals here and he'll give a speech, more importantly is going to be his meetings that take place later this week in Washington, D.C. Of course, he'll be at the White House. He will go to Congress. How does he convince Republican lawmakers that at the moment are still unnerved and concerned about sending more taxpayer dollars to Ukraine that they should pass that bill? Remember, the U.S. administration, the White House, asked for in a supplemental spending bill more Ukraine aid. And what Kaylee was just talking about, that Ukraine aid was missing from that CR that the Republicans were discussing last night in a phone call.
It's amazing that, so many people are skipping not just Putin and Xi, but we saw there Macron and others in the Western world who are our allies not coming. Is the UN kind of dropping in its level of importance?
Well, that's a great question. I think every time you have these big UN General Assembly meetings, the question remains, is the UN obsolete? I mean, Zelensky has said that the Security Council should be dissolved and the whole thing needs to be really redone because Russia stands on the Security Council while the UN writ large has condemned the war in Ukraine. They really can't do much about it when you have Putin sitting on the Security Council. So it's a big question, but at least this forum does provide an area and an arena for a dialogue.
All right. And we're glad to have you here in New York. Anne-Marie Horton, thank you very much for that. For some of the sector price action this morning, let's get over to Bloomberg's Abigail Doolittle. This market just opened 22 minutes. Abigail, what do you see?
Well, we have a very small decline here for the S&P 500, Matt. And from a sector standpoint, not a lot of drama here, as John would like to say. On bottom, real estate, utility. So as yields go higher, the dividends of those sectors look less attractive. Up top, communication services, energy getting a bid once again on oil strength, tech also higher. Now, interesting, Andrew Sliman earlier was saying that into the end of the year, he expects this rally and he would like a diversified growth value portfolio. That's actually what's happening over the last month. You can see tech, energy, financials, utilities, a little bit of everything there for anybody, all higher. It's going to be interesting to see whether this trend will in fact continue into the end of the year.
Yeah, absolutely. Although I think even Andrew said September is, not the strongest trading month historically. We know it's the worst, and he expects that trend to continue. Abigail Doolittle, thanks very much for that. Coming up, the market-moving events you need to be watching out for. That's next in our trading diary. This is Bloomberg. This is Bloomberg's The Open. I'm Matt Miller, in for my good friend Jonathan Ferro. Quick look at the markets as we stand 25 minutes into the trade. We're looking at the NASDAQ 100 up about 0.1%, the S&P 500 down about 0.1%. It's time now, though, for our trading diary to show you what you should be watching all this week. President Biden speaking at UNGA, the UN General Assembly, tomorrow on Tuesday. On Wednesday, we get the Fed rate decision and a news conference from Chair Jerome Powell. Then the BOE announcing its decision on Thursday. Plus, we'll get U.S. jobless claims and existing home sales on that day for the U.S. of A. And finally, on Friday, a BOJ rate decision. This was the countdown to the open. I'm Matt Miller for John Ferro. This is Bloomberg.